Darrell Jones, Director of Research and Hedgeye. Welcome to Macro Show for October 10th, 2023. Busy week, busy day, lots of inflation data later this week, but we'll get right into it for today.
We have our investing summit as well.
Kicks off at 11 a.m. today, so there's going to be some 3 days and 9 interviews. For that, it's going to be an awesome day, or a few days of information, back and forth, Q&A. So
yep,
great.
Excited for that. I get to do 5 shows a day for 3 days. I can learn a lot. Hopefully you do too. Top 3 things this morning in the notebook. Number 1, we're going to hit on Asia. Number 2, hit on interest rates, of course, and then shorting SPY as you would at the top end of the risk range. First, and Qs, by the way. It should be Qs. Did you guys put SPYs in there? It should be Qs. I have Qs. You guys put SPY in there? Come on, put Qs. It took me a while to put Qs in there, so I want that back in. It's not every day you see Qs in the top 3 things, or that I'm going to short Qs today. But first on Asia last night, you have this uniquely American FOMO, of course, with the magnificently manipulated 7 stocks that were and have been manipulated on very low volume yesterday. You can see that versus the 1 day or the one month moving average, you're down like 21% and 19% respectively. So that's what yesterday was. It was actually the second lowest day of volume on a full day as opposed to a half day of the year. So it's pretty easy to bully the tape or to put in bully orders. We saw that. I wrote about it this morning. But Asia woke up and said, like look at China. I even put a new little color coding on this Chinese chart. You can see that China is pretty much right back to the lows. I mean, it was down 0.7% last night. Guys, we've got problems with our graphics. I can't see anything. You can pop that up there. There we go. Thank you. So you can see that, and then I put a little green there. See that, Jonesy? How I filled in the colors? I'm evolving, like as an artist. Really, I think that's critical. So what I was trying to show you there is that's what a bear market looks like. Okay. And for those that struggle with me not going bullish on things we've been bearish on for a while, why would I be? I mean, we went bullish on China and then immediately flipped back to bearish because the bull market did not manifest. So there's no difference between that and Qs really. If you go back to that point in time, Jonesy, you can look backwards where that green part is. You could have been long like we were long Qs, long Bitcoin, long China, and then the bear market started. So you have, of course, that is a damn good looking bear market chart, a little bear porn for the crowd. Dr. Kospi, it's another good example of something that we were long and then we got out of. That was down as well last night. So again, what we call these are daily divergences. There was also divergence with India up a 4%. Of course, Japan was up a lot. So again, the things that we don't like or the signal doesn't like was down. The things that were long were up. That's great. That's called a divergence. But again, not a uniform chase of the U.S. narrative that, bond yields are done going up, and we found 2 Federal Reserve people we could interview that could say something not really hawkish. Really? Ahead of the CPI accelerating on Thursday? Good luck with that. But we got them on interest rates, and I like getting them. I like getting them in a corner. Because these bulls, right, they're bullish when inflation goes up. They're bullish when inflation goes down. That's Tom Lee. Because he was bullish going into the beginning of the bear market in 2022. Of course, he said, I'm close to different earnings. That's actually true. But then earnings, of course, peaked and then rolled over, and he had to change the narrative. He even went as far as to say yesterday that Israel was bullish for the stock market. So again, it's just permanently bullish marketing. That's what he is. He's a marketer. He doesn't go both ways. There's no risk management there. What we want you to do is take their narratives. Okay, I'll take your down bond yields, and I'll see you at CPI on Thursday. Because that's 22 basis points higher from where your new bull market rests. And the downside, by the way, in the 10-year yield only has like 14 or 15 basis points left to a big higher low at 4.50%. Now, 4.50 is really consequential. I mean, I'm old enough to remember basically the last 2 years where I kept saying, if the 10-year yield can't get above its prior cycle high, which was 4.25%, that would be bearish. Maybe that'd be a time to buy TLT. I didn't. I was very good discipline. As you know, there were points in time where I was long some IEF, had it on very short lease, and I used the signal. I don't opine and try to gaze at the stars or my navel, for that matter, and try to tell you a new narrative for everything. We just stay with the process. The signal continues to say the best you can do is 25 basis points above the prior cycle high of 4.25 on the 10-year at 4.50%. Think about that. If you're not thinking about that, you should be. Or I wouldn't have put it in the top 3 things. And finally on Qs this morning, there it is. Look at that. Another fun game they love to play is up Qs on Monday. Oh, yeah. I didn't even realize this till I looked at it, and then I popped the rooster, and I'm like, how many Mondays in a row has the Qs been on? He said, well, Coach, every Monday. other than 4 Mondays ago for like 15 Mondays. So I just started laughing. I just laughed at myself, right? Like when I'm asking these questions after I do the macro show, I just sit by myself like a loser. Like I'm just by myself. But it's fun, isn't it? Isn't it fun? Yeah, because what's really happened is that you go week over week, you review your portfolio, your returns. If you have a 60-40 portfolio, you're totally screwed this year. If you start buying duration or TLT too early, or start buying utility, some rate sensitivity, you got smoked. So every Monday, you're like, shit, I got to sell some of these losers, and I just got to buy these the MM7 basket. That's what's happening. But again, as you know, and we're old enough to remember, U.S. stocks, S&P 500 have been down for 4 of the last 5 weeks before we got the last 2 days of a bounce. You're also old enough to remember last week at this time when I went to 0 shorts and real-time alerts. Why is it that some of you, and I am talking to you, why is it so easy for you to get bearish at the top end of the range when you're not really good at covering at the low end of the range? We need to work on that. You know who you are, all right? Those are your top 3 things. I'm going to short a piece of that. I'm going to do it. Like slack. I'm a hockey player. I'll do it. Everyone with the exception of my wife can run for the other. I'm going to do it, John. I'm going to walk right out there and do it. Now this, I use a slap shot analogy. You ever see the movie with Paul Newman, Beauty? Did you know that this beauty right here, the one with the little head, his first place that he wanted to go to, or he decided to go to after being in South Africa, was Sask. Saskatchewan, as Americans like to call it, or as they did in Slapshot. The Americans would call it, oh, he's from Saskatchewan. It's called Sask, okay? So here you go, a nice little picture of Elon in Canada there, 1989. See that? He went to Canada, took the Greyhound bus, hey, bud? Okay. But what he said was, you know, and I used this quote this morning, I was used to South Africa where people would just rob or kill you. In SAS, they're not going to do that unless you, like, steal their beer. Okay? So I tried to make that into, like, when I came from Thunder Bay, Ontario, which is, at least in terms of latitude, on the right part of the map with SAS, came to Wall Street, I'm like, shit, some of these people are going to, if I'm in the wrong neighborhood, Jonesy's seen it. One night we had quite a night. If I'm in the wrong neighborhood in this city, I could get killed. I could get robbed. If I go to Wall Street every day, they want to rob me. Yeah, then when I started seeing success, I realized that people on my own team wanted me to get killed. Yeah, it's a nasty place, okay? And if you tell the truth about it, you'll know more about it. So I did this morning in the early look. It's much more important to be street smart than book smart, okay? And understand how the street moves capital, understands that there is a they. Yep, they do what I just said. You know, there is a thing called exit liquidity that they need to create because they've been totally offside since August the 1st. And they need a bunch of yodels in the retail community and or hedge fund community. Both are just as bad as the other. Like those baskets yesterday. The top 2 baskets yesterday were high retail, the Goldman baskets, which I highlight in the early look, generating control. Number 1 basket was the high retail sentiment basket. That means that most people own those stocks that wouldn't model a company if they were paid to, because they wouldn't know how. Okay, so you got those stocks, and then you have the liquid, most short baskets. So Goldman looks at their prime brokerage data and shows you what hedge funds are most short. Now, the dirty secret is a lot of hedge funds really suck at short sell. They short low, like at the lows last week, and they cover high, like yesterday. Okay, on no volume. Don't do that. You know, be like Hedgeye. It beats a large percentage of hedge funds that behave that way. So when both of those things are happening at the same time, CNBC is like, oh, look, the Fed's dovish. Israel doesn't matter, even though oil's up. Don't talk about that. You got it. You're getting better. You're getting better. Seeing the game as pros see it, as opposed to the way that people only get paid if things go up, need to see it. Okay? Very different setup. We're going to go through some of those things, those items in the investing summit as we would, because I'm not going to avoid any topic, by the way. 4214. 4214. And last I checked, we've never been fired by an institutional client for calling the game what it is. You know, they quite like the insights that we provide. And it takes a lot of experience and street knowledge. Of course, that's why they call it the street. 4351. So this went up a little bit. Just a little bit. Can you handle that? Problem is that that's not only a big lower high, Jonesy Buds, but that is inside of the old Tier 1 alpha flip line, right? Because that line today is 43.90. So this can be down 2.8% from here into Thursday, or by the end of the day today for that matter. Nobody should be surprised. Nobody should be surprised as CPI accelerates on Thursday. We reviewed that on the call. That's what our numbers imply. So when I say nobody should be surprised, that's because I have a probable outcome. And then you get the yodels on the tweet handle that are like, you want to hear that. You want to see that. You know, if you play the game at the highest level, the best thing that you can be chirped at is by some guy 3 times your weight with popcorn in the stands. Okay? So again, that's what I do. Yeah. Let's do more of that, right? I like that. I enjoy that. It's a fun part of the game. Jonesy had a good buddy, Rio, who, when he wasn't getting a lot of ice time in junior hockey, he just decided to leave the bench and go sit with those fans and order himself some popcorn, did he not?
Left the bench, went up when there was equipment, bought some popcorn, ate some popcorn, went back on the bench, had a 5-minute shift, and then they traded him to Fort Mac.
That was it?
Yeah.
Fort Mac, that's in the AJ.
Yeah.
The Alberta League. That Rio, he's not from Saskatchewan, he's from Alberta. What else we got going on for you this morning? I know there's some more hockey stories. And we are proud of our culture, our hockey culture, because it's an accountable one, it's a transparent one. Try finding a hockey player who's not, you'll find them, and then they get sent to much worse places than having to play in Fort Mac. What else we got going on for you this morning? Oh, did I say 1660 on the, nothing changed here. 1660 actually did change, it went higher. So that's a big higher low for that. Big higher low for the 10-year yield. Big higher low for the US dollar. Nothing changed. I love that. You know I love it, right? When Telecom Tom has to say Israel's bullish, that's the new narrative, and nothing in our process changed from a currency signaling perspective, a bond yield signaling perspective, an oil perspective. Oh yeah, that's what we're talking about. That's when we see opportunity. That's why it says selling opportunity in the, quite literally, in the headline title of the early look. You can show that off if you want, General, it's okay. How about showing off some, you didn't show the volume. I don't know what's going on there technologically. Oh, there it is. See how bad that was? Terrible volume. So again, up day on down volume, up to lower highs on lower volume, up to lower highs within a bearish trend on lower volume. Do you hear me? Oh yeah, it's all math. Yeah, you can see that. What else we got? Bongo board. Now, if you like stocks, why weren't you long the sector that was up the most? Tommy, asking for some friends, up 3.34%. That was a hell of a day. Right, so we stayed with XLE obviously as an asset allocation. We stayed with the oil, and I sold some of both. Yeah, that's what you do after an update. After you buy some on down days, you sell. That's a big update. It's one of the biggest updates we've had. Now, if you like for the energy side. Yeah. So, we good? You guys got something going on here?
Having a day here. I'll figure it out.
All right, excellent. What else we got here in the notebook? No change in cross asset class. Well, did you see the move index? So, the girl from the Dallas Fed said that she doesn't need bond. What did she say? Did she say that if bond yields go vertical, that the Fed doesn't have to raise interest rates? No shit, Sherlock. Right. Because the bond market called you guys out and raised rates for you, Sherlock. Right? You got it. But the move index hasn't changed. Right? Everything else I just said hasn't changed. Who cares what the girl from Dallas said, other than taking that as an opportunity for you and the fam? Right? You take advantage of that. What else we got? High yield. Oh, well, got another selling opportunity in high yield. OXLC, short that on the open. That's the CLO. These guys in Greenwich own a bunch of CLO exposure. That'll be fun when the recession starts in T-minus now. Don't forget we have the recession really finding its way to headline news. These guys in Greenwich own a bunch of. Take advantage of that. What else we got? High yield. Oh, well, got another selling opportunity in high yield. OXLC, short that on quarter number GDP. After the Q3 GDP number is good, where people owning a bag of bones or a bag of bag holding or a bag of shit, when it comes to CLO exposure, really? I mean, I keep getting to short that at a lower high. OXLC, yeah, you and me. HYG, I shorted some of that yesterday too. If it gets to the top end of the range this morning, I doubt it will. I would in real-time alerts. Look at the correlation risk now, gentlemen. S&P versus dollar. So again, we're buying dollars, shorting SPY. It's paid out beautifully for the last 90 days, the last 15 days. If you're not doing it for the last 30 days, you're not doing it right. You got to play better. Yeah, you got to get better, right? And that's going to be easy for you to do today, to buy the damn dip in the dollar. Would love to get that signal too. Did cover some euros yesterday because they were down, but I'm going to go back to shorting more of that, yens, et cetera, which have been great as well. Now look at this short-term vol setup ahead of CPI from If you look at the Tier 1 alpha data, I've said it before, I use this data to augment my process. So you can see now, Jonesy, the CPI today, this time it's only at 18, on at the money implied vol. And I have a 20.66 on my number at the top end of my range. So I like that. So that means that the setup for short dated vol is to the bear's favor, or to those that are going to be shorting bonds or anything like that, which would include utilities, consumer staples, et cetera today. And then the other thing is if you take the short term, and I reviewed this in the current macro themes deck, there's short term, super short term vol, ODTs, et cetera. Then you have the long term picture of gamma and volatility. Look at that picture. I highlighted that this morning. I put some red arrows on it, Gendron. It was one of my first tweets. It says gamma. And I've used this chart before. See this? Those are like the twin towers of death. I mean, I don't know what they call that, the death cross or some whatever. I just call it very, 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 very dangerous, okay? Don't forget that last time gamma went negative and stayed negative, you had all of Wall Street on their knees by June, from January to June, and here we are, no matter where you go from August again. So I think that that was the mother of all bubbles. I've said it many, many times. It was within the mother of all markups, the second circle. That's when people were forced to chase performance, had to chase the Russell, a broadening of the U.S. equity rally, which they don't talk about anymore. Did you notice that the Russell went negative year to date into the end of last week and nobody wanted to talk about year to date? No. I want to talk about my 7 stocks. Okay, great. Most portfolio managers can't beat that anyway. What else we got? I already hit on Asia. Oh, what a day. Europe's going to have a bunch of short selling opportunities. Do I have any European shorts on the board? Not many, but I'm going to definitely add to anything I do, and I'm rank order. Let's do this. Greece, G-R-E-K. That's Greece. The local market's up almost 3%, so that's top of the pile. Poland, 2%. E-Pol's the ticker on that. And going to add Italy to a very long list of European shorts that we've made a pile on for a while now. EWI is the ETF on that. Reloading on EWQ, France or Germany, EWG, I have no problem with that, and I will for the family as well. What else do we got going on? I'm gonna make short selling or hedging a very positive experience in people's lives, okay? Because it is positive in terms of the outcome shorting Europe has been. What do we got? Look at this risk range on oil, Jonesy. 82 to 95. So, there's a reason why I sold some oil. Volatility just had a massive breakout towards 39 on OVX. Now that wasn't a sell all oil signal, but I was selling my calls that I was buying late last week. I was selling some of the physical position. So that position came down. You can see that now in the portfolio solutions. That went right to the top of the list to the bottom third of the list, I think. And if it's not at the bottom third, it'll be there by the end of today. So again, that's what I'm doing with it. If you're uncomfortable with it, don't play the game that way. If you couldn't buy it when it was down, then I don't know what else you can do other than just chase Google. Now, we like Google and Meta, but I wouldn't chase them here because I don't chase in general. You should have bought those when they're for sale. Today, you can sell those two stocks. Everybody knows that those are our two favorite, right? Those are the signals favorite, and my analyst likes both. And he said again today that both companies are showing accelerations in revenues as opposed to decels in revenues at Microsoft and Apple, which remain bearish trend this morning, and I am going to short more XLK as well. What else? Gold. Look, you don't need to go far to see that this was a manipulated U.S. stock market. I mean, look at what gold has to say this morning. Dr. Kospi already talked about the Asian divergences. How about Dr. Copper? All three of those are down. There are only two doctors in the Hedge Eye Macro Playbook: Copper and Kospi, and gold down. What does that say? It means that we're probably going to be right by Thursday on what happens. And by the way, on Wednesday you get the producer price index too. Okay? So stay with the process. The entirety of the picture is much more clear than it will ever be to some monkey, some spy monkey on CNBC. What else we got going on for you this morning? 2-year yield back towards the low end of the range. That got there before the 10-year yield did, but who cares? I mean, you know what to do when something's at the low end of the range or the top, and a good spot to take some questions.
Okay, so you've gone from 28 positions last week to 21 positions as of yesterday.
To 19.
To 19. In the, I guess, macro pro asset allocation. What current exposures are providing the best signal strength on a trending basis? And I guess probably the way people can determine this is what's moving up.
Yeah, well, that's an explicit answer. It's not a feeling. It's not a thesis. I can get you to the thesis. I mean, India clearly has the most signal strength in anything major global equity. It also has the best economic rate of change data. That's it. There's no thesis. There's no white paper. I'm not flying to Bombay. No, that's it. Right? That's it. We said it last week. That's it. Kid. That's it. That's it. Samash, Samash. It should work in any language, because if you look at the asset allocation model, and now what you can get weekly for a lower price than what the Macro Pro subscribers are going to pay for daily, and by the way, a bunch of people are like, hey, I want to get it daily. But obviously, because you just get the answer to the question. If everything you want to know every single day is, if I could look inside of Keith's account, what is it? That's the answer. On the long onlys. When the market was down yesterday, Jonesy, my long only was up. When the market was down, I'm talking U.S. stock market. When it was down, I was up. When it was up, I was up. These aren't lies, and that was with uranium Dow. You can see I was showing last night that in the MoFo, the energy position for rocking and rolling. That's the main reason why. If those go down today, then maybe I'll be down. We'll have to see. But the position re-ranked today before you get it, and again, this is going to change. It's going to change after I make some sales on the open. But I mean, you're going to have number one would be CTA and US dollar. Those are the incremental adds. I've also added to my small cap India S-Min yesterday because it was down.
Does the signal like any ag here? EDA, corn, cane?
No. Or I'd be longing.
Easy answer.
Yeah.
We've had version of this question a few times, but
What's happened in ag is you get a counter trend bounce to the top end of the range, and the corn's down after doing that yesterday, for example, down 0.6%.
A couple weeks ago, you mentioned OBX greater than 33 has you concerned at the time. OBX risk range was 23 to 31. We now have OBX trading around 37 this morning. How do you think about portfolio risk management and some spikes of volatility within bullish trends?
I already told you. The answer isn't go, have a panic attack in the restroom if you're at work. The answer was to, assuming you have live quotes, to have seen oil volatility doing that yesterday on the up move, and to have sold a little bit more aggressively. Okay, so you're going to see where the USOs move down. When the volatility goes up above trend, the price isn't below trend yet, 82.01 for WTI, but trend for OVX is 36.5. If you've taken good note, if volatility breaks up above my trend, that's a sell some signal. That's not a buy signal. In this particular setup. So.
XLE is nearing the top of the ETF Pro risk range and seeing its implied volatility trend downward, but still positive. Are you seeing anything new in the signal related to the REIT complex? And if so, is the signal suggesting any opportunities in addition to MPW and Rexford investing ideas?
That's a lot. XLE versus our top REIT shorts. Okay. The simple answer is energy. If you're long it, you're selling some today. If it's nearing the top end of the risk range, which XOP is as well. PSCE, which is our small cap energy position. So you'd be selling some of those, and you'd be shorting REITs. You'd be shorting utilities, anything that's rate sensitive. So XLRE, yes. You'd be shorting MPW to zero, always at the top end of this range. And you can get the risk range on MPW. On the weekends, I go through that one because it's been in our investing ideas product, which is longer term longs and shorts, which we've been doing fantastic. Some guy says to me on the weekend, yeah, but why don't you show the Playboy? Or so XLRE, yes. You'd be shorting MPW to zero, always at the top end of this range. And you can get the risk range on MPW. On the weekends, I go through the top end of the XLE versus our top REIT shorts. Okay. The simple answer is energy. If you're long it, you're selling some today. If it's nearing the top end of the risk range, which XOP is as well. PSCE, which is our small cap energy position. So you'd be selling some of those, and you'd be shorting REITs. You'd be shorting utilities, anything that's rate sensitive. So XLRE, yes. You'd be shorting MPW to zero, always at the top end of its range. And you can get the risk range on MPW. On the weekends, I go through that one because it's been in our investing ideas product, which is longer term longs and shorts, which we've been doing fantastic. Some guy says to me on the weekend, yeah, but why don't you show the Playboy? What? Like, if you're still dwelling over it because you're an idiot and you take 10, 20, 30% positions in single stocks, that's totally on you and why you're tweeting like that. What we do is we build a diversified short bar. We move in incremental units of inventory. Thanks to all you students for learning that. So that, when you get your first job interview, you say, I'm not some old wall dummy, right? You don't start with that way. Like, you're the old wall person interview. But anyway, we want to have a diversified book of shorts. When they get to the top end of the range, which you can look at all those shorts in the Investing Ideas product, I would. REXR, it's another good one. It was pretty close yesterday. REXR was, U-Haul, UHAL was another one that was close to the top end of the range for Rob Simone. MPW, there's 3 shorts right there.
Tier 1 Alpha, you touched on this a little, but Tier 1 Alpha conveyed that negative gamma conditions have drastically improved with around 580.
Did they say drastically? I don't remember the word drastically.
Improved with around 5. Yeah, this person wrote drastically.
Yeah, but you just put in your own word when that's an important word when you're talking about math, right?
With around 580 million to hedge per index point, and the gamma flip line is now 43.90. How can a positive gamma regime impact our broader U.S. equity exposures in our current positioning?
Well, we know how it would, but that's not the setup.
Easy answer.
What would the impact be of the puck going into your net? They get a goal. I just don't understand the drastic. The question implies that you should get long. That's what I'm reading in your question. Tier 1 Alpha saying there's a drastic change here in gamma, and what do we do if it goes positive? You're having that moment. You should go aside. I already reviewed it all. I already said when the flip line is above the top end of the range and we're in a negative gamma situation. I mean, if it's gone from per index point this morning, it's like $580 million. I mean, that's still like on the order of magnitude, $580 million. Do you think I know the numbers? Yeah. What do you know what 580 million? That would actually be a drastic number per index point. So I want to help you help yourself with your own issues. If after 2 days you're just looking for why market go up when Keith writes selling opportunity and he's setting up for market go down, I don't know how we're going to get along. Because I don't play in fear of the puck being in the back of my net. I want to put it in their net. Okay? We're going to use the process, put it in the back of their net. It's a negative dealer gamma situation. Everything that I just said, blah, 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 blah. Short spots, short cues. We good? Or are you scared? Not going to put you on the power play if you're scared. Can't play that way.
All right, since we have 3 hours of the investing summit coming up, I'm going to wrap it up a little bit early there, but we appreciate everybody dialing in today, and hopefully you can join for some of the great conversations we're having over the course of the next 3 days. Have a great day.
And good morning from the control room, everybody. As Jonesy was saying, 11 o'clock today, the first day of the 11th Hedge Eye Investing Summit kicks off with Liz Ann Saunders. Then we got Jim Bianco, and author William Cohen is going to join us in the 1 o'clock slot. It's going to be a great time. Keith and you are going to get a great education from all these guests. So tune in at 11 o'clock. Macro Show subscribers, check your email for your registration button. Click it right there. It'll take you right there. Automatically enroll you to view it. It's going to be a lot of fun. Tune in at 11. See you then.
Summit as well.
Summit kicks off at 11 a.m. today, so we'll do some 3 days of 9 interviews. Hopefully you tune for that. It's gonna be an awesome day or a few days of information, back and forth, Q&A. So
Yep, excited for that. I get to do 5 shows a day for 3 days. And learn a lot. So we do 2 top 3 things this morning in the notebook. Number 1, we're going to hit on Asia. Number 2, hit on interest rates, of course, and then shorting SPY as you would at the top end of the risk range. First, and Qs, by the way. And should be Qs. bear market started. So you have, of course, that is a damn good looking bear market chart, a little bear porn for the crowd. Dr. Cosby, it's another good example of something that we were long and then we got out of. That was down as well last night. So again, what we call these are daily divergences, the result of divergence with India up a 4%. Of course, Japan was up a lot. It's something that went long. So there's a point bull. Thank you. So you can see that, and then I put a little green there. See that, Jonesy, how I filled in the colors? I'm evolving as an artist, really. I think that that's critical. So what I was trying to show you there is that that's what a bear market looks like. Okay, and for those that struggle with me not going bullish on things we've been bearish on for a while, why would I be? I mean, we went bullish on China and then immediately flipped back to bearish because the bull market did not manifest. So there's no difference between that and Qs, really. If you go back to that point in time, Jonesy, you can look backwards where that green part. Dr. Cosby, it's another good example of something that we were long and then we got out of. That was down as well last night. So again, what we call these are daily divergences, the result of divergence with India up a 4%. Of course, Japan was up a lot. So again, the things that we don't like, or the signal doesn't like, was down. The things that were long were up. That's great. That's called a divergence, but it's not a uniform chase of the U.S. narrative that, oh, bond yields are going up, and we found two Federal Reserve people that we can interview that can say something's not really hawkish. Really? Ahead of the CPI accelerating on Thursday? Good luck with that. But we got them on interest rates, and I like it. I like these bulls, right? They're bullish when inflation goes up. They're bullish when inflation goes down. That's commonly. They're bullish going into the beginning of the bear market in 2022. Of course, we say, oh, inflation goes up. Stocks are super nice. That's actually true. But then earnings report peaked and then rolled over, and you had to change the narrative. He even went as far as to say yesterday that Israel was bullish for the stocks. So again, it's just permanently bullish marketing. That's what he is. He's a marketer. He doesn't go both ways. There's no risk management there. What we want you to do is take their narrative. Okay, I'll take your debt bond yields, and I'll see you at CPI on Thursday, because that's 22 basis points higher from where your new bull market rests. And the downside, by the way, in the 10-year yield only has like 14 or 15 basis points left to a big higher low at 4.50%. Now, 4.50 is really consequential. I mean, I'm old enough to remember basically the last 2 years where I kept saying, you know, if the 10-year yield can't get above its prior cycle high, which is 4.25%, that would be bearish. Maybe that'd be a time to buy TLT. I did. I was very good discipline. As you know, there was points in time where I was long some IEF, had it on very short lease, and I used the signal. I don't opine and try to gaze at the stars or my navel, for that matter, and try to tell you a new narrative for everything. Just stay with the process. The signal continues to say the best you could do is 25 basis points above the prior cycle high of 4.25 on the 10-year at 4.50%. Think about that. If you're not thinking about that, you should. Or I wouldn't put it in the top three things. And finally on Q's this morning, there it is. Look at that. Another fun game we love to play is up Q's. Oh, I didn't even realize this till I looked at it. And I popped the rooster on. How many Mondays in a row is the Q's? Well, Coach, every Monday, other than 4 Mondays ago, for like 15 Mondays. So I just started laughing. I just laughed at myself. Right? Like when I'm asked these questions after I do max, I just sit by myself. But it's fun. It's fun. Yeah, what's really happened is that you go week over week, you review your portfolio, your returns. If you have a 60-40 portfolio, you're totally screwed this year. If you start buying duration or TLT too early, or start buying utilities and rate sensitivity, you got smoked. So every Monday, you're like, shit, I got to sell some of these losers, and I just got to buy these the MM7 masters. That's what's happened. But again, as you know, and we're old enough to remember, U.S. stocks S&P 500 has been down for 4 of the last 5 weeks before we got that the last few days of bounce. You're also old enough to remember last week at this time when I went to zero quotes and I am not. And it is so easy for you to get bearish and tough in the ring, but you're not really good covering the market. You need to look at you know you are, right? So you're tough. You're good. Like slash. Walk right out there and do it. Now this, use a slap shot. You ever see the movie called Beauty? This beauty right here, one with the little head. These first places you want to go to, you decide to get the top of in South Africa. The SAS. Saskatchewan is the American place called. They did in Slapshot, the American called, oh, here's from Saskatchewan. It's called SAS. Okay? So here you go. So a nice little picture of Elon in Canada. But what he said was, you know, and I used this quote this morning, I was used to South Africa where people would just rob or kill you. In SAS, they're not going to do that. They're going to steal their beer. Okay. So I tried to make that into, like when I came from Thunder Bay, Ontario, which is at least in terms of latitude, on the right part of the map with SAS, I came to Wall Street. Shit, some of these people are going to, if I'm in the wrong neighborhood, don't be seeing it. One night we had quite a night. If I'm in the wrong neighborhood in this city, I could get killed. I could get robbed. I go to Wall Street every day, they want to rob me. And then when I started seeing success, I realized that people on my own team wanted me to get killed. It's a mess. Okay? And if you tell the truth about it, you'll know more. So I did this morning in the early look. It's much more important to be street smart than book smart, okay? And understand how the street moves capital. Understands that there is a day. Yeah, they do what I just said. You know, there is a thing called exit liquidity that they need to create because they've been totally offside since August and first. And they need a bunch of yodels in the retail community and or hedge fund community. Both are just as bad as the other. Like those baskets yesterday. The top 2 baskets yesterday were high retail golden baskets, which I highlight here with General Neutral. Number 1 basket was the high retail setting. That means that most people own those stocks that wouldn't model a company if they were paid because they wouldn't know how. Okay, so you have those stocks, and then you have the liquid most short baskets, the golden looks for front brokerage data, which is what hedge funds are most short. Now the dirty secret is a lot of hedge funds really suck at short selling. They short low, like at the lows last week, and they cover high like yesterday. Okay, on no volume. Don't do that. You know, be like Hedgeye, it beats a large percentage of hedge funds behave that way. So when both of those things are happening at the same time, CNBC's like, oh, look, the Fed's dovish. This really doesn't matter, even though it wills up. Don't talk about that. You're getting better. You're getting better. Seeing the game as pros see it, as opposed to the way that people only get paid things to up and ease. Okay? Very different setup. We're going to go through some of those things, those items in the investing summit as we wish, because I'm not going to avoid any topic, by the way. 4214. 4214. And last I checked, we've never been fired by the institutional client for calling the game what it is. You know, they quite like the insights that we provide. It takes a lot of experience and street knowledge. Of course, that's why they call it the street. 4351. So this went up a little bit. Just a little bit. Can you handle that? The problem is that that's not only a big lower high Jonesy bug, but that is inside of the old Carolina Alpha flip line. Because that line today is 43. So this can be down 2.8% from here to into Thursday, or by the end of the day today, for that matter. Nobody can surprise. Nobody should be surprised if CPI accelerates on Thursday. We reviewed that on the call. That's what our numbers imply. So when I say nobody should be surprised, that's because I have a probable outcome. And then you get the yodels on the feed handle that are, you want to hear, you want to see. Now, if you play the game at the highest level, the best thing that you can be chirped at is by some guy 3 times your weight with popcorn in the sand, okay? So again, I like that. Jonesy had a good buddy, Rio, who was getting a lot of ice time in junior hockey. He decided to leave the bench and go sit with those fans. And we're going to go sit with popcorn.
Went up and put that popcorn back on the bench. 5-minute shift. Then they traded him. Fort Mac.
That was it?
Yeah.
Fort Mac, that's in the agent.
Yeah.
Alberta. That Rio, he's not from Saskatchewan, he's from Alberta. What else we got going on for you this morning? There's more hockey stories. And we are proud of our culture, our hockey culture, because it's an accountable one, it's a transparent one. Try finding a hockey player who's not, you'll find them, and then they get sent to much worse places than having to play Fort Mac. What else we got going on for you this morning? Oh, did I say 1660 on the, nothing changed here. 1660 actually did change, it went higher. So that's a big higher low for that. Big higher low for the 10-year yield, big higher low for the US dollar. Nothing changed. I love that. You know I love it, right? When Telecom Tom has to say Israel's bullish, that's the new narrative, and nothing in our process changed from a currency signaling perspective, a bond yield signaling perspective, an oil perspective. Oh yeah, that's what we're talking about. That's what we see opportunity. That's why it's a selling opportunity in the, quite literally, in the headline. You show that off if you want. How about showing off some, you didn't show the volume. I don't know what's going on with technological. Careful. So again, update on down volume, up to lower highs on lower volume, up to lower highs within a bearish trend on lower volume. Do you hear me? Oh yeah, it's all happening. What else we got? Bongo boy. Now, if you like, why weren't you along the sectors that was up? Tommy, asking for some friends. That's 3.34%. That's a hell of a day. Right, so we stayed with XLE, obviously, as an asset allocation. We stayed with the oil, and I sold some of both. Yeah, that's what you do after an update. After you buy someone down there, you sell. That's a big up. One of the biggest updates we've had. Now, if you like,
Having a day here. Having a day here. I'll figure it out.
What else we got here? And no change across asset class. Well, did you see the move index? So, the girl from the Dallas Fed said that it's a. She doesn't like it. She doesn't need bond. What did she say? Did she say that if bond yields go vertical, that the Fed doesn't have to raise interest rates? No shit, Sherlock. Right. Because the bond market called you guys out and raised rates for you, Sherlock. Right? You got it. But the move index has to change. Right? Everything else I just said has to change. Who cares what the girl from Dallas said, other than you're taking that as an opportunity for you and the family, right? You take advantage of that. What else we got? High yield. We got another selling opportunity in high yield. OXLC, short that on the open. That's the CLO, like these guys in Greenwich own a bunch of CLO exposure. That'll be fun when the recession starts in T-minus now. Don't forget we have the recession really finding its way to headline news. In January, that's when you're going to get the fourth quarter number GDP. After the Q3 GDP number is good, where people owning a bag of bones or a bag of bag holding or a bag of shit, when it comes to CLO exposure, really? I mean, I keep getting to short that at a lower high. OXLC, yeah, you and me. HYG, I shorted some of that yesterday too. If it gets to the top end of the range this morning, I doubt it will. I would in real time alert. Look at the correlation risk now, General. S&P versus dollar. So again, we're buying dollars, shorting spot. It's paid out beautifully for the last 90 days, the last 15 days. If you're not doing it for really the last 30 days, you're not doing it right. You got to play better. You got to get better. Right? And that's going to be for you to do today to buy the damn the dollar. Would love to get that signal too. Did cover some euros yesterday because they were down, but I'm going to go back to shorting more of that. And the yens, et cetera, which is great as well. Now look at this short-term vol setup ahead of CPI from them. If you look at the Sherwin Alpha data, I said it before. I use this data to augment my process. So you can see now, Jonesy, the CPI today is not showing 18, on after money implied vol. And I have a 20.66 on my number at the top in my range. So I like that. So that means that the setup for short-dated vol is to their favor, or to those that are going to be shorting bonds or like anything like that, to include utilities, consumer staples, et cetera, today. And then the other thing is if you take the short-term, and I review this in the current macro team today, there's short-term, super short-term vol, ODT, et cetera. Then you have the long-term picture of gamma and volatility. Look at that picture. I highlighted that this morning. I put some red arrows on it. One of my first pieces says gamma. And I've used this chart before. See this? Those are like the twin towers of death. I mean, I don't know what they call it, the death cross or some whatever. I just call it very, 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 very dangerous. Okay. Don't forget that last time gamma went negative and stayed negative, you had all Wall Street on their knees by June, from January to June, and here we are, no matter where you go from August to June. So I think that was the mother of all bubbles. I said it many, many times. It was within the mother of all markups, the second circle. That's when people were forced to chase performance, had to chase the Russell, a broad negative U.S. equity rally, which they don't talk about anymore. Did you notice that the Russell went negative year to date into the end of last week and nobody wanted to talk about year to date? No. portfolio managers can't keep that in. What else we got? I already hit on Asia. What a day. Europe's going to have a bunch of short selling opportunities. Do I have any European shorts on the board? Not many, but I'm going to definitely add to anything I do. And I'm rank order. Let's do this. Greece, GREK. That's Greece. The local market's up almost 3%, so that's top of the pile. Poland, 2%. E-polls a picker on that. I'm going to add Italy to a very long list of European shorts that we've made a pile on for a while now. EWI is the ETF on that. Reloading on EW2, France for Germany, EWG, no problem with that, and I will for the family as well. What else we got going on? I think short selling or hedging, very positive experience because it is positive in terms of the outcome toward Europe has been. What do we got? Look at this risk range on oil, 82 to 95. So there's a reason why I sold some oil. Volatility just had a massive breakout towards 39 on OBX. Now that wasn't a sell all oil signal, but I was selling my calls that I was buying late last week. I was selling some of the physical position. So that position came down. You can see that now in Portfolio Solutions. That went right to the top of the list, to the bottom third of the list, I think. And if it's not at the bottom third, it'll be there by the end of today. So again, that's what I'm doing. If you're uncomfortable with it, don't play the game that way. If you couldn't buy it when it was down, then I don't know what else you can do other than just chase Google. Now we like Google and Meta, but I wouldn't chase them here because I don't chase in general. You should have bought those when they're for sale. Today you can sell those two stocks. Everybody knows that those are our two favorites, right? Those are the signal's favorite, and my analysts like both. And he said again today that both companies are showing acceleration in revenue as opposed to decels in revenue that Microsoft and Apple, which remain bearish trend this morning. And I am going to short more XLK as well. What else? Gold. Look. You don't need to go far to see that this was a manipulated U.S. stock market. I mean, look at what gold has to say this morning. Dr. Kosky already talked about the Asian beverage. How about Dr. Copper? All three of those are down. There are only two doctors in the head macro playbook: Copper and Kosky, and gold down. What does that say? It means that we're probably going to be right by Thursday on what happens. And by the way, on Wednesday you get the producer price index too. Okay, so stay with the process. The entirety of the picture is much more clear than it will ever be for some monkey, some spy monkey on CNBC. What else we got going on for you this morning? 2-year yield back towards the low end of the range. That got there before the 10-year yield did, but who cares? I mean, you know what to do when something gets low end of the range. So the top, in a good spot.
Okay, so you got from 28 positions last week to 21 positions as of yesterday.
The 19th.
In the, I guess, natural co application. What current exposure is providing the best signal trend on 10 basis? And I guess other ways to determine up.
Yeah, that's an explicit answer. It's not a feeling. It's not a thesis. And I can get you to the thesis. I mean, India clearly has the most signal strength in anything major global equity. It also has the best economic rate of change data. That's it. There's no thesis. There's no white paper. I'm not flying to buy that. No, that's it. Right? That's it. Just sit it left. Sit. 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 Samat. Samat. You should work in any language because if you look at the asset allocation model and now what you can get weekly for a lower price than what the Mac Pro subscribers are going to pay for daily, and by the way, much people are like, yeah, I want to get it daily, but obviously because you just get the answer to the question. If everything you want to know every single day is, if I could look inside a Keith's account, what is it? That's the answer. On the long only. When the market was down yesterday, Jonesy, my long only was up. When the market was down, I'm talking U.S. stock market. When it was down, I was up. When it was up, I was up. These aren't lies, and that was with uranium down. You can see I was showing you last night in the MOPO. The energy positions were rocking and rolling. That's the main reason why. If those go down today, then maybe I'll be down. We'll have to see. But the position re-ranked today before you get it. And again, this is going to change. It's going to change after I make some sales on the open. But I mean, you're going to have number one would be CTA and US dollar. Those are the incremental adds. I added to my small cap India estimating yesterday.
Does the signal like any ag here? DBA, corn, cane?
No. Or I'd be long it.
Easy answer. We've had version of this question a few times, but
What's happened in ag is you got a counter trend bounce to the top end of the range. Corn's down after doing it. Down 0.6%.
a couple weeks ago you mentioned OBX greater than 33 had the concern at the time of OBX risk sharing was 23 to 31. We now have OBX trading around 37 this morning. How do you think about portfolio risk management and these spikes of volatility within growth trends?
I already told you. The answer isn't go, after that. The answer was to assuming you have black close, to have seen oil volatility doing that yesterday on the upward, and to have sold a little bit more aggressively. You're going to see where the USOs move down. When the volatility goes up above trend, the price isn't below trend yet, 82.01 for WTI. But trend for OBX is 36.9. If you take a good note. Shorts. Okay. The simple answer is energy. If you're long it, you're selling some today. If it's nearing the top end of the risk range, which XOP is as well. PSE, which is our other small cap energy position. So you'd be selling some of those, and you'd be shorting REITs. You'd be shorting utilities, anything that's rate sensitive. So XLRE, yes. You'd be shorting NPW to zero, always at the top end of the range. And you can get a risk range on NPW on the weekends. I go through that one because it's been in our investing ideas product, which is longer term, longer shorts, which we've been doing fantastic. Some guy says to me on the weekend, "Yeah, but you can show the pay point." Like if you're still dwelling over it because you're an idiot and you take 10, 20, 30% positions in single stock, that's totally on you and why you're doing that. What we do is we build a diversified short book. We move in incremental units of inventory. Thanks to all you students for learning that. So that when you get your first job interview, you say, "I'm not some old wall dummy." Right? You don't start with that habit. But anyway, we want to have a diversified book of shorts. When they get to the top end of the range, we can look at all those shorts in the investment ideas product. I would. REXR is another good. It was pretty close yesterday. REXR was U-Haul, UHAL was another one that was close to the top end of the range for Rob Simone. MPW, there's three close rates.
Tier 1 alpha conveyed that negative gamma efficiency drastically improved. It's around 500.
Did they say drastically? I don't remember the word drastically.
Improved. It's around 500. Yeah, this improved drastically.
Yeah, but you just put in your own word when that's an important word.
With around 580 million to hedge for index point. Gamma supply is about 43. How could positive gamma
Well, we know how it would, but that's not selling. What would the impact be of the puck going into your net? Negative one. I don't understand. The drastic. The question implies that you should get long. That's what I'm reading in your question. Tier 1 alpha saying there's a drastic change here in gamma, and what do we do if it goes past? You're having that moment. I already reviewed it. I already said when the flip line is above the top end of the range, and we're in negative gamma supply, it's gone from, for index point this morning, it's like 580 million. It's still like on the order of magnitude, $580 million. You think I know that? You know what 580 million, that would actually be a drastic number for index point. So I want to help you help yourself with your own issue. If after 2 days you're just looking for why market go up, keep right selling opportunity, and it's setting up the market go down, I don't know how we're going to get along. Because I don't play in fear of pucking in the back of my neck. I want to put it in their neck. Okay? We're going to use the product, put it in the back of their neck. It's a negative dealer down situation. Everything that I just said, blah, 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 blah. Short five. Short you. You good? Are you scared? I'm going to put that five for you.
All right, so we have about 3 hours for the investment side coming up. I'm going to wrap it up a little bit early there, but we appreciate everybody down on Wednesday, and hope you enjoyed some great conversations we're having over the next 3 days. Great.
And good morning from the control room, everybody. As Jonesy was saying, 11 o'clock today, the first day of the 11th Hedge Eye Investing Summit kicks off with Liz Ann Saunders. Then we got Jim Bianco and others going to join us in the first spot. It's going to be a great time. Pete and you are going to get a great education from all these guests. So tune in at 11 o'clock. Macro Show subscribers, check your email for your registration button. Click it right there. It'll take you right there automatically.
to help keep our online platform safe from cyber threats?
It is, with Comcast Business. No one does fall travel like Amtrak. Big cities to small towns. Amtrak gets you there in
I'm the founder of Concordia Growth Partners, a private investment company based out of Vancouver, British Columbia, Canada. And not long ago, I had the unique pleasure of hosting a call with Peter Zion, author of the New York Times bestselling book, The End of the World is Just the Beginning, Mapping the Collapse of Globalization. And over the last year, my team and I have been using Peter's content as a way to challenge our thinking and broaden our perspective. And the goal of this call was to get his thoughts as it relates to Canada in particular. And we talked a lot about Canada. We also talked about a whole bunch of other stuff, China to Russia to inflation to ChatGPT. It was a really interesting conversation, and I'm excited to share it with you on YouTube here so that you can hear it for yourself as well.
We're going to talk about a lot of Canada here. Whether or not you're going to like what I have to say is another question.
Okay, we'll see.
There's a lot there to cover, and I want to make sure we have enough time for interaction because I know there's going to be a lot of questions from some of the jump right in here. So this first slide is the net worth of Americans by age bracket, specifically by tenure chunk. Now, as you get older, you get raises, you get better at your job, maybe you start a business or buy a farm, you become wealthier. It tends to increase with your age, but the real magic happens when you turn 50, because that's when your single biggest expense
that's a big comment. The Chinese system failing. I'm sure you're going to get into that, but I'd love to hear more about that.
Now, remember that transition from farm to city? This is new, historically speaking. It used to be that we had a demographic structure that looks a lot like Nigeria did. And so it doesn't matter if people who are 65 retire, because there's more people living. And the proportion of old versus young has stayed more or less static since the dawn of American history. But with the Americans changing the world with globalization, we went a different direction. We've been to the cities. We had fewer kids. And 75 years on, this is the American demographic now. Suddenly it matters if everyone who's 65 retires, because now it's not a small sliver, it's the largest generation in American history. And on average, the American baby boomers retired in the fourth quarter of calendar year 2022. So we've always known in the United States that between January of 2021 and December of 2023, the cost of capital in the United States was going to go up by a factor of 5, simply because of demographics. Everything that the Federal Reserve does is on top of that. Anything that we do to fight inflation is on top of that. We're only about halfway through that process right now. Now, within this one picture, there's any number of stories to tell. So in the case of the United States, we're obviously losing the boomers to retirement. That is the largest generation we've ever had, the largest workforce we've ever had. And we're replacing them with the Zoomers, which are the smallest generation we've ever had. In calendar year 2022, that was a shortage of 400,000 workers. And we know that that number is going to increase each and every year for the next 12 at least, until we hit a shortage of 900,000. So we're kind of locked into this labor shortage period for at least the next decade. Probably better to think of it as 2, because that's just the bottom. We start crawling out of it. And we won't be back to a 2019 labor structure in the United States until the millennials' kids come of age. That's the mid-2040s. So all we have to do in the United States is wait 20 years. Now, there's lessons from this for everything, especially when it comes to real estate. The boomers are downsizing, the millennials are finally moving to the suburbs and raising their families. It's changing the balance of supply and demand across the entire market. Now, Gen X, that's my generation, looks at the baby boomers, and we feel a healthy volume of disgust. We really don't like the way they have led their lives or led the country or formed their families. When the boomers entered the workforce in the late 60s to the early 80s, there were so many large generation, so many of them, that they pushed down the cost of labor. And that meant that boomers competed with one another for the price of labor, which meant that they were working below maybe what their skill set would justify. It also meant that they were the most mobile generation America ever had, because they felt they had to go to wherever the jobs happened to be. And once they got there, they discovered that that still wasn't enough. And a lot of boomer families decided that the second parent had to enter the workforce as well. That generated a lot of pressure on the family unit, and is the single biggest reason why the boomer generation has the highest divorce rate in American history. And Gen X looks at that like, we're not going to make that mistake. We're making different mistakes. For us, our time is at least as important as our money. And we are far more likely to be single income households. Now, to this point, that has really worked against us, because in the local home total poll, there have been so many boomers that we have seen the lowest raises, the lowest increases in take-home pay annually of any generation in history. But we have more durable family units and marriages as a result. It's been bad until about 2 years ago. Because 2 years ago, it became clear that most of the baby boomers were about to retire, the labor market started to shift. And all of a sudden, Gen X is in high demand. And even if we all wanted to work, and we do not, there would never have been enough of us to fill those shoes in the first place. So we're now seeing raises on par with the greatest increases in take-home pay in American history. And it's got another 10 years to run. Now,
So-
go ahead.
I think COVID obviously has clouded a lot of this for everybody, and I think a lot of people are attributing a lot of the change and disruption to COVID, which undoubtedly it has to have played a role. But do you think if COVID didn't happen, would we still be seeing a lot of this today and having these same conversations?
I'd argue that we're seeing the pressure of Gen until Gen X starts to retire, and that is not for another 12 to 15 years. So you should expect a small number of relatively well-capitalized buyers dominating the top end of the markets. In residential, you got to consider what Gen X's approach to life is going to mean for the office, because the only thing that Gen X hates more than going to the office is the commute to get to the office. Remember, this is a generation that defines itself as valuing their time more than their money. And now Gen X are the managers, and they're taking over all the top positions throughout the world, and they don't want to go in. So you should expect significant changes in corporate policy that is going to damage an entire real estate asset class for at least the next decade.
That's super interesting. And as a millennial, I think I'd argue that valuing of time isn't just a Gen X thing; it's a millennial thing and probably a Zoomer thing as well. So
yes and no. I mean, this is one of those things that we won't know until we know. And the millennials are still relatively young, and the Zoomers are only now entering the market. But the initial stuff that I've seen suggests that, like all those reports that we heard about how young people were being really damaged by the isolation of COVID, that holds true for the millennials. The millennials are eager to get back into groups, and that includes being around the office cooler. The Zoomers are different. The Zoomers are loners. They prefer to work solo. They don't like to interact with a lot of people directly. They're very loyal workers, but they never want to actually meet you. So I think the model moving forward will probably be a team of millennials, mostly in the office, not exclusively, who are doing the collaborative, cooperative managerial leadership work. And then a satellite of Zoomers who work remote, who feed in the information that's necessary, with the Xers and their families probably in the Bahamas for the quarter because they don't want to be there at all, and they figured out they can do it all remotely. Some flavor of that is probably what we're looking at.
very interesting.
So the American demographic situation is changing, and based on who you are, that's either very good or very bad. But it's nothing compared to the titanic shifts we're seeing everywhere else. Now, these blue arrows are pointing at America's millennials. They are providing consumption now to support the American economic system. And in a few years, they will be providing the investment as they get into their 50s. And their children will also be a large generation. They're just now being born, and that will round up the labor market 20 years from now. So in the United States, you only have to wait 10 years for a better capital environment, and you only have to wait 20 years for a better labor environment. But holy crap, look at everybody else. The German system, it was terminal 40 years ago. They're not running out of children. That happened 20 years ago. They're now running out of working-aged adults. And we are going to see some degree of industrial collapse in the German space by the end of the decade, assuming nothing else Brexit before then. And some of the outcomes of the Ukraine war may well do that in the next 2 years. And then there's China. China's workforce is already the world's fastest aging, and we now know that this data is wrong. The Chinese about a year ago started admitting publicly that they've overcounted their population by at least 100 million people. With all of the missing millions, people who would have been born since the one-child policy was adopted 40 years ago, meaning that they're all under 40. That suggests that these yellow bars don't even exist. We don't have an economic theory for what would work with this demographic in 2030. We are in the final decade of the Chinese country. And there's all kinds of things that have to do with energy or food or fertilizer or manufacturing or trade or war that could end this sooner. But China's use-by date is just 8 years away at this point.
Well, I said there might be some controversial opinions that you have, and that's one of the more interesting ones, I think. There's a lot of things that people take for granted. They take for granted globalization, they take for granted low interest rates, they take for granted low inflation. And I think a lot of people have taken for granted China's rise and the idea that it's going to take over and eclipse the United States. And it's going to be interesting to see how this plays out.
Yeah, well, the Chinese government itself, the CCP's propaganda arm, is no longer talking about overtaking the United States economically. That should tell you everything you need to know, because the propaganda always overshoots, and now they're starting to dial it back really, really significantly.
Yeah, one of the points I've heard you make in the past is how nobody's benefited more than China from the U.S.-led international order and the U.S. policing of trade routes, that sort of thing, making it possible for everybody to trade with everybody. And it's always seemed strange to me if that's true, that China has kind of fought that idea. I mean, perhaps there's been some signaling that that's changing.
Well, as Tip O'Neill used to say, all politics are local. And the way the Chinese system consolidated in the post-Maoist era is you had a guy by the name of Deng Xiaoping, who picked who would rule China for the next 20 years. Two guys, Xi Jinping and Hu Jintao. But he knew that he wasn't smart enough to see past 20 years. So he told those two factions that they then had to come up with a compromise candidate to succeed them. And that person is Xi Jinping, the current chairman. Xi spent the first years of his term doing a purge of anyone in the country who was a potential political opponent, and then spent the next 5 years of his term purging everyone system who was capable of independent thought to make sure there would never be a challenge at all. And now he sits atop the heap, but there's no one in the country who's intellectually capable of helping him, and no one in the bureaucracy wants to bring him news that might elicit an opinion because they don't know what's going to piss him off. So we're seeing a government breakdown from the inside at the very, very top, because all policy starts and stops with one person, even if it's the smartest person in human history, it couldn't manage a system as large. But at the same time, you've got this dependence upon the United States for all things energy and manufacturing. So the solution for the last few years has been blatant nationalistic, narcissistic, lambasting propaganda in order to make sure that the population is fully on board with them. That works until it doesn't. And one of the things that we've seen in just the last few days is Xi has reassigned a guy by the name of Zhao Lining, who used to be the spokesperson for the Ministry of Foreign Affairs. He's the guy who popularized the term wolf warrior diplomacy, which is basically throw everything in everyone's face all the time, blame everyone for everything, make up stuff on the cuff, and if it sounds good to make someone look bad. And he has been the forefront for the anti-American propaganda throughout the Chinese system for the last 3 years. Well, now he's been assigned to basically border control. It's difficult to come up with a more blatant downsizing of somebody's authority. So it is possible that Xi has realized just how deep the doo-doo is and is starting to dig out, but I'd argue that it's too late. One of the few things that the American political spectrum agrees on is that China needs to be taken down a few notches. And so we're seeing a steady crunching of American policy down on China, specifically with tech in the last couple of months, but we're going to see it with energy going into the next couple of months because of some of the shifts that are happening in the Ukraine war. Remember that we now have a price cap and no insurance for any Russian exports. That means that stuff is going to fall off the market pretty soon because no one can insure the ships to make sure that they leave. That's probably going to cost the Chinese 2 to 3 million barrels a day of Russian crude. That is more than enough to cause an energy-induced depression in the last several years, even assuming the United States stops with its onslaught and everything else. So we want to do a lot more than change the mouthpiece if they want to make the United States friendly.
The head of the U.S. Navy recently warned that the U.S. military must be prepared for the possibility of a Chinese invasion in Taiwan before 2024. That's coming up pretty quick. First question, how likely do you think a war in Taiwan is to be?
It's the U.S. military's job to be prepared. Criticism there, but I don't think there's going to be a war. Every assumption that the Chinese have made about war, because the Ukraine war has been, every assumption that the Ukrainian, try the sentence again. Every assumption that Beijing has made about how war happens has been proven wrong by the Ukraine war, and they now need a completely new plan. It's possible that Xi has been so isolated for so long that he's forgotten a little bit about the basic position of China in international affairs, but I don't think so. And I think he knows if there is a war, that is the end of China as a country, as an industrialized entity. It would be national suicide. So I personally find that very unlikely. The only reason that I can think of that the Chinese would do it anyway is if you know in your heart in China that the end is near anyway, demographic collapse, energy crisis, food crisis, trade crisis, then maybe there's something to be said for pulling the trigger, because at least then you get to write the narrative of what's next. And if you can do that and keep the CCP in power for the low cost of 500 million dead Chinese, then maybe it's worth considering. The smart way to fight Taiwan or China is not within its own coastal waters. It does have a large navy. They don't have much range, but there's a bunch of ships. The smart thing would be to put 2 destroyers in the Indian Ocean basin and cut the energy flows. China imports 80% of its energy. 75% of that comes from just the Persian Gulf, and most of the rest comes from Africa, so it's on the same route with the Indian Ocean. So 2 ships would be enough to send it to zero, and the Chinese war machine would stop within days, and the Chinese economy would stop within weeks, and the Chinese population would be starving within months. It would be very, very easy, and Xi knew this 3 years ago. Whether or not he still remembers it now that there's no one reminding him of it is an open question. We just don't know. But if there was a war, China would fall very, very, very quickly. That doesn't mean that they couldn't inflict damage. That's not what I'm saying. All of Japan and Korea and Taiwan are within range of their air force and their missiles. It would hurt. But destroying China completely as a modern system would be child's play. As for what the Americans would feel, there's really only one sector where we would feel it. That's electronics and manufacturing. And there is no way around that, especially when it comes to things like computing and assembly. Now, pros and cons. Pros, China is not very high value add. There's nothing that China makes that can't be made somewhere else with a more sustainable supply chain at a lower price point. We've learned that because of COVID. Cons, the sunk cost of the industrial plant in China is immense, and it would take the United States at least 5 years to rebuild those supply chains in the Western Hemisphere, noticeably in NAFTA, and that would hurt. There's no way around that. That said, after 5 years of reindustrialization, North America would have experienced 5 years of the fastest growth in its history. And at the end of the day, would have supply chains that are shorter, simpler, that employ locals, that sell to locals, that are cleaner, that use the most advanced technology that's available today, and are largely immune to international shocks. transition we have to go through one way or another because the Chinese demographic picture is utterly unsustainable. It is a death pact. A war would speed that up, obviously. So I would argue that North Americans need to do this regardless, and the sooner they get started and the faster they go, the less painful.
Putin's made a lot of fanfare about their relationship and how close they are. And then every now and then you seem to see some news coming out of China that Xi's not very happy with Putin, and he wants to see, a plan for how the war is going to end. And so, what do you make of that relationship, and where do you see that going?
Oh, Xi is pissed. There's no doubt about that. When they did the whole no holds barred friendship, the Chinese assumed that this was going to be a quick war. But one of the fun things about when you plan to say take over Taiwan is you make certain assumptions about how things are going to go, and the Chinese have been making certain assumptions for 45 years, and the Russians have now proved all of them wrong. So for one, the Chinese thought this would be a fast war, and they looked forward to the Ukraine war being a template for Taiwan. And here we are, dragged on a year later, and Russia's not doing great. And they always knew that the Taiwan war would be tougher than Ukraine because you can walk to Kiev, and the Ukrainians have only been preparing for 8 years. You got to swim to Taipei, and the Taiwanese have been preparing for 45. So assumption one gone. Assumption two, Russian weapons are great, so let's steal the IP and clone them and outfit our equipment. They spent 30 years and $3 trillion US doing that, and now they're having some very serious buyer's remorse. Assumption number three, Russia is too important. No one will sanction it. Well, that went out the window. And say what you will about the Russian economy, it's corrupt, it's inefficient, but wow, is it a massive producer of energy and foodstuffs? China's the world's largest importer of both. Hell, they import 80% of the inputs that allow them to grow their own food. You take the sanctions that are on Russia, you put them on China, you get a deindustrialization collapse complete with a famine that kills 500 million people within a year. So every assumption the Chinese have made, Putin has proven wrong. And the Chinese are not happy about that because it now means they have to start completely over, but now they're in a one-man dictatorship and there's no one left to come up with a plan B. Let me talk about the Ukraine war a little bit just so the stage is set, and then we'll move
Sure.
on to Canada. So what you're looking right here is the Russian space, north is to your right. The map on the right is a population density map, and that lighter color of orange is roughly the population density of the southern third of Manitoba if you remove Winnipeg. So yes, you've got neighbors, yes, you know their names, you've probably lost track of their lives. If you go to the left, the green zone, that is the Russian wheat belt. Of the world's major agricultural zones, it's the least productive agricultural zone in the world, of the major ones. In the winter, it's about like northeastern Alberta, so cold, dry, windy, and in the summer, it's like western Kansas, hot and dry. You go to the right, the blue is tundra and taigai. Go to the left, the yellow is desert. The output, agricultural output from the green zone is so poor, so low, that the Russians have never been able to generate enough economic activity in order to build a road network. So if you're going to move anything in the Russian space, rail is your only option. But what really drives the Russians to drink is the beige on the shoulders, territories that are completely flat but are economically useless even by Russian standards. And you can totally shove a Mongol horde through that. So the Russian strategy is to expand out of the green through the beige and block up the geography. Get to these areas when you can't run a panzer division through them because they're too rugged. And then forward position those rail-supplied, slow-moving troops in the access points between. Putin's been working on this for 23 years. There have been 7 conflicts in the former Soviet space since then. They have all been about rebuilding the old Soviet position in these access marks with the hopes of plugging them so that foes cannot invade. Russia has been invaded 50-odd times in their history, and every time the foe has made it to the wheat belt, the green zone, they've never pushed them out. It's been the weather that's done it. The only time that Russia has ever been secure was during the Soviet period, because then the access points were blocked. Now, I realize there's no one in Europe that's looking to invade Russia right now, but the Russian demographics are as terminal as the Chinese demographics, and they know if they don't act now, they will never be able to act again. They see this as an existential struggle for their own survival. And they're right. But to give them what they want, you have to subjugate over 100 million other people, and that's never been in the cards. There are any number of economic after effects from this, but the one that's going to be mattering the most in North America is what's going to go down in Germany. We're looking at a pipeline map here. The red lines, those are the natural gas pipelines, and this is the one that matters the most. This is Nord Stream. It provides direct access from the Russian natural gas fields under the Baltic Sea in Germany, and when it was shut off last September 1, it was 40% of Germany's total intake. And then later in September, somebody blew it up, and it's never coming back. Now, 40% of the total means that this is not a marginal supplier. And if you only have a marginal disruption to your energy input system, things get really bad really quick because energy demand is inelastic. If you need a liter of gas to get to work and you only get 9/10 of a liter, you will pay whatever you have to get that last tenth. But then what you pay for that last last 10 determines the entire price for the entire market. So in losing 40% of their total, the Germans are now struggling with natural gas prices that are 7 times what they were before the war. And even if they replace all of the volumes with other suppliers, those suppliers will be marginal and they will be more expensive and riskier, and it won't affect the price because the main stuff is offline. And the Germans don't use energy like we do in North America. I mean, in the United States, we talk a good game when it comes to energy paranoia about independence, but we really don't care. So we take energy from Mexico, from Canada, from Saudi Arabia. If it's looking, we'll take some from Venezuela on the side. You can't do that in Germany. Precision manufacturing needs reliability. So the Germans rely on long-term deals with fixed infrastructure supplied by state companies that they think are more reliable. Well, that whole thing is broken down now. And then they use that natural gas not just to generate electricity, but it forms the basis of their petrochemical sector. And for the most part, those petrochemicals products are not exported. They're kept in-house, and they form the basis of the manufacturing sector. It's all gone. The Germans are having a good month right now because it's atypically warm. Unless that's the future for every winter, this is only temporary. We're looking at a breakdown of the entire German manufacturing sector. BASF, that's a big chemicals company, is literally physically dismantling their industrial plant across Germany and shipping it to other locations, most notably Louisiana in the United States, in the hope that they can reassemble it, tap US shale gas, and ship the end product back to Germany to save their country. But that's going to require a build out in Louisiana that is faster than what the Nazis did in Germany in World War II. More likely, this is just the end of the German economic model. And the German system is heavily integrated into Denmark, and Austria, the Netherlands, and Belgium, and Poland, and the Czech Republic, and Slovakia, and Hungary. So we are looking at the end of Central Europe as a modern, industrialized system. In less than 2 years.
So Japanese Prime Minister Fumio Kishida is making his first official visit to Canada next week, and there's speculation that he's looking to Canada to provide them with liquefied natural gas. German Chancellor Scholz visited Canada in August seeking liquefied natural gas as well, but the response that he got from Ottawa was, don't count on it. And I think in that case, the Liberal government questioned whether those terminals could be profitable or built fast enough to make a difference to Europe's long-term supply difficulties. So all of this was before Nord Stream was blown up in September. So I got to ask, what do you think? I mean, obviously that's got to change the equation. Should Canada be in the business of exporting liquefied natural gas?
I try not to use the word should because everybody's going to come at this from a different point of view. I can't tell you that the business case has improved drastically because the Russians are one of the world's major exporters of LNG, both from from their northern coast in the Arctic as well as from the Sakhalin projects, and those are all going to go down for lack of foreign partners and tech. So you take that offline and the business case improves. The desperateness of the Germans and specifically the Europeans in general, the business case improves. And if we have a follow-on dust up in a place like the Persian Gulf, then we're looking at Qatari natural gas potentially falling offline as well. So that would suggest again that the business case will improve. But you know Canadian internal politics better than I do. If you want to bring the natural gas from Alberta, let's be honest, that's where almost all of it is. If you go east, that's a lot of provinces that can say no for whatever reason that they want. And even if everyone says yes on day one, you still then have to build a liquefaction facility with a pipeline. That's a multi-year project. That's not going to be soon enough to help the Germans. Now, if you go west through BC, that wouldn't take nearly as much time. And that, because the Japanese are not facing a acute crunch, they've got a little bit more time that they could, in theory, get by without it. One thing about the Germans is they have systematically shut down one part of their energy system after another. So they're now completely dependent on lignite and natural gas from Russia. Now they lost natural gas. So Germany is now one of the most carbon-dirty countries on the planet. Japan's different. They don't have a unified grid. Every city has an LNG import facility, a coal-burning facility, what little green tech they can get, and they have some tidal stuff, and they have LNG import facilities. So each one is used to shuffling things around, and if you can throw LNG into that mix, they will all do better, but it's not as critical as it is for the Germans, but mostly the Japanese have it.
A lot of the opposition to LNG export pipelines in general comes from the environmental risks, the environmental concerns. How do you think about the differences between the environmental risks of LNG versus oil?
Well, natural gas, if you're going to burn it for power, as a rule, generates roughly half of the carbon that a coal plant will. So in terms of net increase, if you just look at the German case where they're burning lignite, it's a lot more than that. So, that's a gain. That's the best way I can say this without deliberately pissing everyone off. The environmental push to get rid of all fossil fuels in most places is actually increasing on Earth. If you're in a place like Germany that doesn't have good wind potential outside of the North Sea and no good solar potential anywhere, putting up solar panels actually increases the amount of carbon time when the sun's not shining very bright because it's the winter. So you're never going to get rid of the fossil fuel in a nuclear-based system. And if you build another system on top of it that doesn't work very well, you're just putting more carbon in the system. Now, that story is different in every part of the planet. If you're in a sunny location like, say, Southern California, by all means, for God's sakes, do solar. If you're in the Great Plains or the Prairie Provinces, do wind. It's brilliant. But you've got to match the technologies to where you are. And one of the advantages of liquefied natural gas is it's the lowest carbon fossil fuel, and it's portable in concentrated form. And for most parts of the world, that is actually the cleanest fuel source that you're going to be able to get.
That's super interesting. So back in August, when the Germans came to Canada asking for LNG, our natural resources minister told Routers that the government now thought the best solution was to export hydrogen, not LNG, specifically because the world is moving away from fossil fuels, as he said. And I'm curious, what do you think of the logic of that? What do you think of hydrogen as a fuel source of the future?
Hydrogen is new, so it's difficult to project what it's going to look like in 10, 20, and 30 years, both from a cost and a carbon point of view. But what we know right now, with the technology we have now, it is the dirtiest fuel source on the planet. Making hydrogen using something other than natural gas as the feedstock means you're using carbon dioxide, oxygen, and water. And those three molecules are the most stable molecules that we are aware of on this planet. So the amount of energy that it takes to break them into something else in order to form methanol and then get hydrogen is the most exothermic reaction that you can do at scale. So anyone who's doing hydrogen with today's technology is actually just setting up a massive carbon bomb. Now, the theory is if we build out more and more and more wind and solar in places that are both windy and sunny, then the energy is free, and it doesn't matter how much energy it takes in order to generate those reactions. But there is no place on the planet right now where that exists, and there is no place in Europe at all that has the wind or the solar potential in order to do this at scale, except for maybe Scotland. And now we're wrapped up in Brexit and Scottish independence. There just aren't too many places where this works, as we understand the technology now. Now, you change the technology, and 20 years from now, it will obviously look different. I will reserve the right to change my mind. But right now, that would actually make our carbon problems far more intensive than they already are.
So, food production has come into conflict with Canada's greenhouse gas emission targets. Ottawa recently announced a plan for Canadian farmers to reduce nitrous oxide emissions to 30% below 2020 levels by 2030. The agricultural industry prefers targets that would reduce emissions on an intensity basis, and that would allow them to keep emissions the same but just produce more food. What do you think of the government's current plan? Obviously, Canada is part of one of the major agricultural belts of the world, and Russia and Ukraine complicated the other one. I know you consider yourself a green. What's the right way to do this?
There are three nutrients that allow us to grow plants. Potash, of which Canada is a world leader. At the moment, that is not triggering the green community. Phosphate, for which North America as a unit is broadly self-sufficient. The Greens are not upset about that. And nitrogen. Arguably, nitrogen is the most important of the three, and nitrogen is what some folks are trying to get rid of. You cannot maintain output levels without high levels of nitrogen fertilizer. Now, the day may come where we have a technology where we can do that in a way with fewer emissions and less runoff. That technology does not exist today. So if Canada does go down this path, it removes itself from being one of the world's massive agricultural exporters, and that will kill several hundred million people. That's a value balance, green versus humanitarian life support.
It's pretty heavy.
Yeah. Now, every agricultural zone is dealing with some version of this question moving forward, because there's a lot of fertilizer disruption coming out of the former Soviet Union, and we all need to find ways to improve efficiencies and output. And using less fertilizer should not be on that list, in my opinion. So Canada has 5 problems that you have to take into account because all of them affect real estate. The first one is geographic and political. The population is stretched out, basically hugging the American border for warmth. And because of the way that Canada was formed as a co-dominion of Anglos in Ontario and Quebecois in Quebec, you have made the decision very early on in your process that the provinces have immense power vis-a-vis the central government. That means you didn't get your first trade deal until about 3 years ago. I'm going to say trade deal, not with another country, within Canada. So internal barriers to trade remain immense, and almost every province in the Canadian system, as this graphic shows, has a greater an economic relationship south with the United States than it does with their own co-nationals. And in that sort of environment, Canada is always going to be incredibly exposed to international trends, especially as it involves the elephant next door. Now, you fast forward 10 years, you do away with provincial autonomy somehow, that changes. I don't think that's going to happen in 10 years.
If we're not trading enough between provinces, what do you see as being the biggest opportunities for us to do more there?
You so used to exporting raw commodities to the wider world because the United States has most markets already, and then just participating in American automotive because that's where the market is. If you really do want to have a cross-Canadian system for trade, you're going to have a much more efficient east-west transport system. But I'm not sure that will work with NAFTA clauses because you have to allow north-south to work just as well as east-west under the clauses of the treaty. So anything that you do is going to be for integration has to be between large population centers, and the only two large population centers that Canada has in very close proximity that can get synergies are Montreal and Toronto. And so for you to solve that, you have to solve the core Canadian identity question over what it means to be Canadian, and it has to be the Anglos of Toronto and the Quebecois of Quebec who answer that question the same way for those two. That's a question you're very familiar with, and I think if you had an answer to it, you would have provided it already. Problem number 2 is strategic. This is a Cold War map, all the dots where the Russians had their military bases. During the Cold War, Canada was in a privileged position. Now, the United States had created globalization in order to build an alliance to fight the Soviets. And whenever we tried to get a trade relationship with other countries, we always had to give in a little bit because we got full security control as a result. So that was the guns for butter trade that defined the Cold War and American strategic policy. Now, Canada, because it's on the flight path for the missiles from the Soviet Union and the United States, could have been a security-free rider. You could have been neutral. To your credit, you chose not to. In fact, to your credit, the Canadians were always the first ones for any fight. If they saw a crisis in the world, they'd pick up the phone, they'd call the president, and the first words the Canadian Prime Minister always said is, "We see what's happening, we're here, how can we help?" And that made Canada our fastest friend. But you weren't dumb about it. The next words out of the Canadians' mouth, after all the security details were worked out, be like, "We would really appreciate a little bit more market access for Quebecois cheese, or Ontarian spark plugs, or whatever it happened to be, softwood timber, if you will." On over 70 different occasions, Canada carved little melon scoop exceptions out of American trade, and all of those were folded into NAFTA 1. And that's how things lasted, until this guy came along. We've been moving away from the globalist approach in the United States for some time, but Donald Trump was the first one to make it the centerpiece of his foreign policy. And he loved Trudeau, because Trudeau was perceived around the world as the only world leader that Donald Trump was smart on. With that in his back pocket, Trump played hardball on trade negotiations, and all of those exemptions that Canada had spent 40 years building the American trade law were jettisoned in the NAFTA 2 discussions. The only reason that there's even an adjudication function in there isn't because of Canada, it's because Nancy Pelosi put it in at the last second within the U.S. House. Now, as we all know, Justin Trudeau is not the brainchild that is running Canada. That would be Christina Freeland. And at the time that Trump was became president, she was your trade negotiator and ultimately your foreign minister. And she attempted to play the old playbook in the NAFTA negotiations. The idea that Canada has a special place in American trade law and is justified in getting its exemptions. And I'm not saying this to denigrate her. I think she's one of the smartest people on the planet right now. But her first week on the job was Trump's first week on the job. And she was handed a playbook that became obsolete the day she took her office. And so she was pushing for things into NAFTA 2 that the United States had no interest in, on labor, on environmental regulations. And at the end of the day, the Americans got sick of it and cut a bilateral deal with the Mexicans to cut Canada out of NAFTA completely. And this is the photo from the stage when she found out. The Mexican and the American negotiators didn't tell her ahead of time. And after this meeting, she was simply told, the United States is going to proceed with this in 8 days with the Mexicans. You have 8 days to accept the original terms. If you don't, fine, you're on your own. 7 days later, Justin Trudeau signed, and we got NAFTA 2. Problem number 3, geography. What you're looking at here is not a population density map. It is a spatial expansion map. So cities that are in green or blue are not very physically constrained. They can expand in almost all directions. That keeps development costs low. Cities that are in red and orange have difficulty. Maybe they have an ocean or a mountain or a national park or some sort of protected wetlands or something. They can't physically expand very easily, and so their internal land costs tend to be very high. That makes for expensive housing. We've got 3 trends that are going on in Anglo-America right now, same on both sides of the border. Number 1, because of COVID, not a lot of people want to be reliant on public transport. Cities with a circle can't function without city transport, so people are moving out. Number 2, the baby boomers on both sides of the border want to move somewhere warm. They don't want to shovel snow in February. Moving south. In the case of Canada, west. And third, the millennials are coming of age, they're raising families, and they want to be in a place where they can have a backyard. They have to move to a place where the land costs are lower. So we're seeing people moving out of the coastal cities, that's on both sides of the border, into the interior, and specifically in the American South, Southwest, and West. You guys don't have a lot of room. I know that Canada is a freaking huge amount. Number two, the baby boomers on both sides of the border want to move somewhere warm. They don't want to shovel snow in February. They're moving south. In the case of Canada, west. And then third, the millennials are coming of age. They're raising families, and they want to be in a place where they can have a backyard. They have to move to a place where land costs are lower. So we're seeing people moving out of the coastal cities, that's on both sides of the border, into the interior, and specifically in the American South, Southwest, and West. You guys don't have a lot of room. I know that Canada is a freaking huge country, but if you start preferencing away from Vancouver and Montreal and Toronto, there aren't a lot of other options. So you're seeing significant distortion across our entire labor structure. Fourth, demographics. Here's your provincial demographics as of 20 years ago. You'll notice a couple things out of Ontario, Quebec, and BC. You guys, for the most part, stopped having kids. You were rapidly aging. Now they have obsolescence, which is very fast. But in this decade, that big bulge of people in their 50s will have moved into their 60s. And then the economic case for the three biggest Canadian provinces